it played a role. I mean, it wasn't the principal factor, but it was part of the problem. But the more immediate cause, and the stronger causes. I mean, you have to go back even further. But the most proximate cause of the financial crisis was the consequence of the economic stimulus that was implemented in the first term of the Bush presidency, and it continued on during the second term. But what happened is when the stock market bubble burst, rather than simply allowing the recession to run its natural course, for political reasons, the government came in and tried to artificially stimulate the economy. And they succeeded. They stimulated the economy by creating a housing bubble. They stimulated it by causing Americans to buy things that they couldn't afford. And so we ran up huge trade deficits as a result of the imaginary wealth that was, people thought they had because of home equity. And, when that bubble burst, we had a bigger crisis. But the Community Reinvestment Act, I mean, that was a small part of it. I'd say the lion's share of the cause was, number one, the Fed. The Fed brought interest rates down to 1%, left them there for years, and then raised rates very, very slowly, so that rates were very low for an extended period of time. And that enabled rampant real estate speculation, because real estate is bought on leverage. And when Americans are buying properties, they're buying the monthly payment. And by keeping the interest rates down, they artificially suppressed the monthly payments, making people, or giving home buyers the ability to afford a larger home or to pay more money for a home than they could have paid had it been more expensive to borrow the money. And also, with the advent of things like interest-only mortgages, that made it even easier because people were only paying the interest. And so the low interest rate was a primary factor. And we also had things called teaser rates. A lot of the subprime, in fact, all of the subprime mortgages were adjustable rate. I mean, there weren't 30-year fixed rate subprime. And subprime loans, a lot of them were these 2 and 28, where you had a teaser rate for 2 years, and then you reset for the remaining 28. And the teaser rate was very, very low because the Federal Reserve kept interest rates so low. And so that's what enabled the rampant speculation. When you combine that with government guarantees from entities like Fannie Mae, Freddie Mac, the FHA, that meant that the lenders really didn't even care if the borrowers repaid the loans as long as they met qualifications to be guaranteed by Fannie or Freddie. That's all they cared about. And I think there was a lot of fraud and corruption in the process because you had all these mortgage originators that knew that if they could get a loan to qualify for FHA, it wouldn't be on their books. And so if it ultimately went bad, they didn't care. And I don't think the agencies really did enough to make sure that the loans that they were guaranteeing actually met what their standards were. But also part of the problem with the FHA and with Fannie and Freddie is every time real estate prices went up, they would simply increase the limits for which they would guarantee mortgages. So instead of holding firm and being an anchor, keeping prices down, they kept upping the limits, and that enabled prices to really rise. In fact, I saw an interview, I think it was on CNBC, with the chairman of I think it was Fannie Mae. But I remember when they first decided, and this is long after the horses had left the barn, that on a going forward basis, they were going to make sure that the mortgages that they guaranteed, that the borrowers could afford the entire mortgage, not just the teaser rate. And what that meant was that Fannie was guaranteeing mortgages simply based on the ability of the borrower to afford the initial low payments, even if they had no evidence that they can afford the higher payments. And when the host asked them, well, why would you do that? I mean, how could you guarantee a mortgage when the guy obviously can't make the payment? Shouldn't you have been doing that all along? And what his answer was, and I almost couldn't believe that he said this, he said, well, people were making a lot of money speculating in real estate, and we didn't want to tell them that they couldn't do that. In other words, they didn't want to rain on the parade. They felt that, well, as long as real estate prices are rising, who cares if they can afford the payments 5 years from now, because they'll sell it by then or they'll refinance it. And so they were guaranteeing these mortgages. It wasn't until real estate prices started to fall, that the bubble already burst, that they started thinking about this. But if Fannie and Freddie never existed, private industry wouldn't have done that. Private industry would have been concerned about the ability of the borrowers to repay the loan, especially if it was on their books, if it was their asset. But it wasn't their asset. Now, you look at a lot of the subprime. Fannie and Freddie didn't guarantee the subprime mortgages, but Fannie and Freddie were the largest buyers of subprime. And so the originators knew that they could sell a lot of their subprime paper to Freddie and Fannie. They were helping make the market. They were helping to generate demand for this paper. That was one of the reasons that they were able to create it. And of course, yes, as the mania grew, as real estate prices rose, as people just believed that they would go up forever, eventually the private sector did come in and securitize these subprime markets without government guarantees. And that's where you had all these gimmicks at Wall Street. But a lot of that had to do with the fact that there was so much cheap money around. The reason there was so much demand for mortgage paper was because the Fed had interest rates so low. And Americans were running these massive trade deficits. Foreigners were recycling them. So they were looking for a place to put their dollars, and Wall Street created it in these structured mortgage products. And, the rating agencies slapped high credit ratings on them without really doing their homework. And that, again, is also a function of government, because only, Moody's or S&P, these companies are government licensed. And rating agencies that aren't approved by the government, really, they can't rate the paper because the buyers aren't allowed to buy it. So that was also part of government. But all of this happened because the government didn't let the market function. The government didn't want a more severe recession in 2001 or 2002. And so we artificially stimulated the economy. We created a housing bubble that never would have existed absent that government stimulus, particularly the monetary stimulus. But also you had to have the guaranteed mortgages. You had that moral hazard. If the government wasn't guaranteeing mortgages, lenders would have been much more, they would have scrutinized these loans a lot harder because they would have borne the risk. But when the government bears the risk, nobody cares. And of course, part of the problems was also in the banks. The banks are participating in this, but you have to remember that banks are working with deposits that are FDIC or taxpayer guaranteed. So the minute you have the government coming into the banking system and guaranteeing depositors that they can't lose money, then the banks will take a lot of risks with those deposits, because the depositor mainly wants higher interest rates, he wants lower costs on his checking account. He doesn't care how much risk the bank has to expose the deposit base to in order to, bring in those returns. Because, if the bank fails, who cares? The government bails them out. The banks know this. The banks know that their depositors don't give a damn about how much risk they take. And so they take a lot of risk. They take a lot more risk than they would take if the government hadn't come in and guaranteed the deposits in the first place. If there was no government guaranteed bank accounts, bank deposits, then depositors would be very concerned about what the banks do with their money, and there would be real competition for safety. Banks would not just advertise, that they have the highest yields or the cheapest ATM fees. They would advertise, hey, we got the best portfolio. We have the highest quality of assets. Your money is safe. So we would have that. So it was all a combination of the ways the government interfered. And, the reason that I was able to forecast this years in advance is I saw the housing bubble. I understood it. I understood how government policy was fueling it. And more importantly, I understood how bad it would be when it came to an end. Because I knew that the whole banking sector was built on this phony collateral. And that once real estate prices went down, a lot of the lending institutions would be insolvent. I also knew that a lot of our phony GDP growth was based on consumption that was driven by home equity extractions, that was driven by the wealth effect, that was driven by the fact that people thought they didn't have to save because they owned a house. And so the money they would have saved, they just spent it. And so all this consumption was being driven by this housing bubble, and a lot of employment was a direct function of the housing bubble, whether it was home building, selling homes, remodeling homes, people buying new furniture for their new homes. All of this activity was taking place as a direct function of the real estate bubble. And I knew that when the real estate bubble burst, all that would come to an end. And so I knew that you'd have a lot of people that would be unemployed, and then how are they going to pay their mortgages? And so I saw this perfect storm of falling home prices, rising unemployment, bank failures, and I knew as this happened, one of the reasons that lenders were so willing to lend money on real estate was because the prices kept going up, and they assumed they would keep going up. But the minute the lenders started to get worried, well, they weren't going to lend anymore. They were going to tighten up their lending standards. They would want bigger down payments, and that would further pull the rug out from under the real estate market. I knew there were a lot of speculators in the market, people that were buying houses not to live in them, but to flip them. And as soon as they stopped going up, they wouldn't want those houses. They would also, all the speculators would become sellers. I knew there were a lot of renters who had been suckered into the real estate market. As a renter myself, a lot of agents tried to, sucker me in. But a lot of people were buying houses not because they wanted them, but because they wanted to get rich, and they thought that they would do it by buying a house. They thought they were throwing money away on rent. And so they bought houses, and once they realized that the house wasn't going up, they wouldn't want it anymore. And especially when a lot of people were buying houses with no down payments. I wrote articles for years on how risky this was, not for the buyer or the borrower, like a lot of people thought. I said, no, the risk was on the lender, because the lender was getting no down payment. The lender had no collateral. That meant the borrower could walk. If the property went down, the borrower could just mail in the keys instead of making a payment. And that's exactly what they did. People were able to make very risky bets with banks' money, or taxpayer money, as it turned out. And if you give people an opportunity to gamble with no downside, they're going to do it. And I saw this going on. I knew this was going to happen. I knew it would end badly. And more important, I knew that when the housing bubble burst and banks failed, including Fannie and Freddie, when I wrote Crash Proof, the original that came out in February of 2007, I wrote that Fannie and Freddie would go bankrupt. I knew that was going to happen. I also speculated that the government would bail them out. I said that would be the wrong thing to do. It would be better if they let them fail, but of course they did the wrong thing, which is typical for government. But not only did I forecast that the bubble would burst and we'd have this financial crisis and banking crisis, and I said we'd have the worst recession since the Great Depression, because I knew we'd have massive unemployment. I also knew the states were going to be in trouble, because I knew that state budgets had been ratcheted up during the boom years. They had increased spending, assuming that the tax revenues associated with real estate were going to continue. And I knew that when the bubble burst and everybody lost their jobs, that the state budgets would be a wreck. And I knew the federal budget. I predicted in Crash Proof that we would get budget deficits that would exceed $1 trillion a year. No one had heard of anything anywhere near that when I wrote that book. But of course that happened. But what I said was, not only would we have this big bubble that would burst, but that the government would once again repeat the mistakes of 2001 and 2002. And that's precisely what we did. We stimulated again. We learned nothing from that experience. Ben Bernanke is more reckless than Alan Greenspan. President Obama is more reckless than President Bush. We have a greater dose of monetary stimulus and fiscal stimulus, which means we're doing even more damage to the underlying economy. And the collapse that is going to result from this round of stimulus is going to be much worse than what we experienced in 2008. I think by a magnitude of greater than 2. It's going to be a lot worse. And people think that the economy is recovering. It's not recovering at all. The economy has gotten worse. We've gotten deeper into debt. We have greater economic imbalances now. We've moved a lot of the losses from the public sector to from the private sector to the public sector. But the economy is more addicted than ever to cheap money. And it's not just the banking system, but the federal government. The deficits now, the national debt is enormous. And the only reason that the federal government can make the payments is because the rates are so low. The only reason a lot of the bailed out financial institutions are solvent is because they can borrow so cheaply from the Fed. But all of this has adverse consequences. You can see it in commodity prices going higher, agriculture prices, energy high prices. Look at the precious metals. Look at what's happening all around the world. You're having food riots. We are creating massive inflation to try to paper this thing over. Meanwhile, instead of addressing the fundamental imbalances that underlie our economy, which is insufficient savings and investment, too much consumption, too much borrowing and spending, too large a percentage of our workforce in government, in services, in finance, in education, in healthcare, not enough people working in manufacturing, in mining, in oil and gas, in agriculture. Instead of allowing our capital and our labor to be reallocated in a more efficient way so that we can produce the goods that we need, we keep the capital and labor allocated poorly, so we don't produce the things that we need, which means we have to run bigger and bigger trade deficits to import what we don't produce, and we keep expanding the sectors of the economy that need to contract. We inhibit the sectors that need to grow, and we're digging ourselves into a deeper hole. And I think that we are approaching the next crisis, because where we are right now is the stimulus is wearing off, so the hangover is setting in, the economy is starting to contract. I think we're headed back into recession. Now the Fed is saying it's about to stop the quantitative easing over the summer, that it's about to raise interest rates. Well, how are they going to start tightening as the economy moves into recession? Because if they tighten, they'll push it over the edge. I mean, we'll be in a deeper recession. I think they're going to change course. I think this is all bluff, that they're going to have to come back with another round of stimulus, and I think this time it'll be lethal. I think the amount of stimulus that would be required to combat what's coming would be an overdose. The economy would literally overdose on government stimulus, and that is a collapse of the dollar, collapse of the bond market, runaway inflation. That's what's coming. And a lot of people will talk about, how we almost averted disaster, that it was going to be terrible in 2008. Well, if it really was that bad, do you really believe that the problem's been solved by government? That just printing a bunch of money, that bailing out entities that should have failed, that somehow this averted Armageddon? I don't think so. All we've done is buy some time. But by doing that, we made it worse. It's very expensive to buy it 2 or 3 years, because now not only are we going to have to deal with the problems that we had in 2008, but all the problems that have now been piled on top of those problems as a result of what the government did to postpone the pain. Certainly, the government has been subsidizing the decision to buy over the decision to rent, and that tax deduction distorts the market and causes people to buy that absent that deduction, they might have chosen to rent. And I think to the extent that the government uses the tax code to alter decisions is a mistake. And we want the tax code to be neutral. We want people to make decisions on should they buy or should they rent based on the economics, not based on the tax code. And I think this is also particularly problematic when people lose their jobs, because a lot of people who decide to buy instead of rent, when they make the calculation of how much they save based on the deduction, the assumption is they have a job. So let's say somebody is deciding between a mortgage payment of $1,500 and a rent of $1,000, and maybe after deductions, their mortgage payment is the equivalent. I'm just making these numbers up, but let's say it's like $900, and now they say, oh, it's $100 a month cheaper because of this tax deduction, and then they buy. And maybe that doesn't count maintenance and property taxes and whatever else. But the problem, what happens if they lose their job? Now, the mortgage doesn't cost them $900. It costs them $1,500 because you don't have a tax deduction because you have no income to deduct your mortgage payment from. So it really exacerbates the downward pressure on home prices and foreclosures when a lot of people who bought homes are now can't afford to pay them because they don't have the $1,500. It would have been easier if they were renting. And of course, if you're renting and you're unemployed, it's not nearly, it doesn't really affect the housing market. I mean, maybe it affects your landlord if you can't pay your rent, and maybe you just move and you rent something less expensive, but there isn't a house that's going to foreclosure. But the government has, encouraged home ownership for a long time based on some dubious analysis. They believe that we're better off having homeowners than renters. And I don't think the government should make that decision. I think the market should make that decision. And I certainly don't think that people who are renting should be taxed to subsidize people who are buying. So we definitely need to get rid of that incentive by getting rid of the home mortgage deduction. Now, that doesn't mean I want to raise taxes. I don't. So what we could do is we could figure out how much that home mortgage deduction is worth. right? How much does the Treasury lose in taxes based on that deduction? And then when we eliminate the deduction, let's lower the rate so that it's revenue neutral, so that we're not sending the government any more money. We're just not distorting the market. So therefore, the average American, instead of getting a deduction for buying a house, he'll just have more take-home pay every month. And now he can decide, without any interference, does he want to use that higher income, because now he's paying less taxes. Does he want to use his additional income to buy a house without a tax deduction, or to rent? And then we'd have prices for both houses and rents reflecting market forces, not artificial manipulation based on the tax code. Well, I think the government has interfered repeatedly to keep interest rates lower than they otherwise would be absent that interference. And they're doing that for obvious reasons, because there are certain factions that favor low interest rates. Principally people who want to borrow money. They want to borrow cheap. So Americans are living beyond their means. They're financing that with debt. And so home buyers and people getting car loans, they want low interest rates. The government is in debt. We're running huge deficits. We have a $14+ trillion national debt. The government wants low interest rates to be able to service that debt. Wall Street, the banks, they want low interest rates because they want to finance all their speculation. And it's a lot easier to do that when the money is cheap. If you have to pay more for the money, then it's harder to make a profit. And these guys are using a tremendous amount of leverage, and leverage gets a lot more expensive with higher interest rates. So you have a lot of factions on Wall Street, on Main Street, that want low interest rates. But nobody thinks about what are the consequences. There are winners, well, who are losers, right? Because it's a zero-sum game. If somebody is benefiting because they're paying low interest rates, somebody is suffering because they're earning low interest rates. And what we're doing is we're destroying savings. We're destroying the ability of pension funds or insurance companies to actually generate returns for their investors, to make claims to their customers. We're undermining the credibility of our banking system. We're destroying, the elderly, people who are living on fixed incomes. They're getting 0% on their CDs. We're destroying the incentive to save. Not only are we encouraging people to borrow, but we're punishing people who save, because the interest rates are now so low that after you pay taxes on it, you're way behind the rate of inflation. So any money you decide not to spend is just money you lose. So instead of a penny saved is a penny earned, a penny saved is a fraction of a penny lost. And so people don't want to do that. So we're screwing up the economy, and we're also causing economic decisions, resources to be allocated in ways that are not are going to be damaging, because interest rates are too low. But we're investing as if we have a huge pool of savings to support these low interest rates when we don't. So we're having all sorts of malinvestments. There's all sorts of damage being done to the U.S. economy because rates are set so low. I mean, if you think about it, interest rates should reflect a balance between the supply and demand for credit in the economy. And the supply should come from savings, money that individuals have decided to forego consumption and set this aside for future consumption, and now they have a pool of savings that they can loan out. And then the borrowers would be businesses or government or consumers or students, whoever wants to borrow that money. And in America, everybody is borrowing and hardly anybody is saving. So if you have all sorts of demand and minimal supply, you would expect the price to be very high. But it's not. It's very low. And if the government allowed interest rates to rise to where they should be, then the market would bring along a realignment, because rates would be so high that would discourage people from borrowing. They would be so high, a lot of people would want to save. And then that would correct the imbalances in our economy, where we'd have more savings and less borrowing, and then gradually over time, interest rates would start working their way lower. But we don't do that. We keep interest rates artificially low, and the longer we do that, the bigger these imbalances grow, and the more painful and problematic it is when there's finally a collapse. And there's going to be a collapse. There's no way to prevent it from happening, but unfortunately, there is a way to delay it from happening. And that is what the government is doing. They're delaying it because the politicians just care about what happens before the next election. And if there's a way to delay the pain, even if it means it makes it worse, they're going to do it every time. But at some point, you run out of time. There simply is no way to kick the can down the road because you've gone to the end of the road. And I think that's where we are. And I think this next economic downturn is going to be the last, because if the Fed tries to stimulate us, as I said earlier, we will die of an overdose. And if they don't stimulate, then we're going to get the real recession, and it'll be much worse than what we would have had in 2001, and even a lot worse than what we had in 2008. Sure, I mean, fractional reserve banking can exist. I think the key is to have banks where you don't have government-insured deposits, and I think ideally you want to have real money that's backed by gold, not just fiat. But in a free market banking system where depositors do not have government insurance, you will still have fractional reserve banking, but not to the extent that we have today, because bankers will have to judge between the profits that they can make by loaning out more than their deposits versus the risk to their institution should there be a run on the bank and they have insufficient reserves to pay off their depositors. So you would have the free market would set an ideal rate, and banks that did it right would be rewarded. And I think you're going to have some fractional reserve banking, and I think it's fine to the extent that it evolves in a real free market. The problem is now we don't have a free market. We have government guaranteeing all these bank accounts, which enables far more leverage to be in the system than would ever exist in a free market. Yeah, well, there were. I mean, but they weren't as bad as the Great Depression, and that's the first one that happened. With paper money, that's the first one that happened with the Keynesian remedies being applied. So I think that the downturns that we had back then were not as bad as what we've experienced, in the 1930s, or even what we've just experienced here in the 2008-2009 period. And I think it's nothing compared to what we're going to have. Now, what I can say is that the price of the fact that we didn't have that many severe downturns, post, let's say, 1987, we had a stock market crash, but even then, so post, we had a pretty bad recession in 2001, 2002. But between, at the end of that recession up until 2008, we never really had any kind of severe downturn. We had some mild downturns. But I would say that the price of that, the reason that we did that, is because the Federal Reserve constantly took action that postponed the pain. But we're about to live through the consequences of those actions. So to say, hey, this was a great success because we didn't have any really bad recessions during that period, well, it's premature to come to that conclusion. Because if all of a sudden we end up in something worse than the Great Depression as the ultimate payback, then you really can't say that that was a successful policy. Yeah, well, Tom Woods talks about that, the Great Depression that wasn't all the time. We created a lot of money. The Federal Reserve was brand new in 1913, and in 1917, the Federal Reserve Act was amended to enable the Federal Reserve to hold U.S. Treasuries because the government wanted to finance World War I by issuing debt. And it did, and a lot of that debt ended up on the books of the Fed. But the money supply was growing to finance the war, and so that created a problem. And when the war ended and they tightened up, we had an economic contraction. The good news was the government was not able to take any action, and therefore the problems corrected themselves before the government had a chance to intervene. Had the government intervened more rapidly, the Great Depression of 2012 might actually, or 2020 might be in the history books. But because the government did nothing, the market corrected the problems in a much more efficient and rapid manner, and the economy moved forward. Problem is, the Federal Reserve didn't learn its lesson. It was too loose during particularly the latter half of the 1920s, and we had easy money. Interest rates were too low once again. I think a lot of it had to do with the desire of U.S. bankers to help out Great Britain and to help prop up the pound by keeping the dollar weaker. And ultimately, when the Fed looked to mop up all that liquidity and tighten, by then, of course, there had been a huge speculative bubble built up in the stock market and real estate market. And when the Fed went to drain the liquidity and tighten, the market collapsed. But again, instead of doing nothing, Hoover decided to come to the aid with his version of bailouts and stimulus. And so instead of getting a free market solution like we had in 1920, we got government solutions, and we had the beginning of the Great Depression. And then, Roosevelt came in and, upped the ante. He just basically took the Hoover plan and made it bigger. He expanded it, and so the Depression lasted through the end of the Second World War. I'd say the Depression didn't really end until the war ended, until government dramatically cut back on its spending and allowed resources to go back to the private sector. That's when we started to see economic growth. Well, they're wrong. I mean, I said the end of the war is what brought us out of the Depression. I mean, if we were still fighting World War II, we'd probably still be in a depression. I mean, it was spending tremendous amounts of resources fighting a war is not good for the economy. Maybe it's good for the people who are making the weapons, but it's not good for everybody else. I mean, life on the home front during the wartime was pretty sparse. I mean, everything was rationed. It was very difficult to get anything, and a lot of people were in the workforce who would prefer not to have been. You had a lot of women working in factories. They didn't want to be there, but their husbands were fighting a war, and they were there making weapons. They weren't making things that they can consume. So all the work that we were doing during the war, it wasn't producing consumer goods. We were making bombs and tanks and munitions. I mean, none of this benefited America. I mean, it benefited us to the extent that we had to defeat the Nazis, but we would have been better off if there were no Nazis to defeat. If Adolf Hitler had never come into power, if we never had to fight World War II, clearly the economy would have had more resources to devote to civilian purposes, which would have contributed to rising standard of living. Instead, we had to devote those resources to fighting a war. Well, that ultimately laid the foundation for the U.S. dollar, becoming the reserve currency, and that is really the source. You asked earlier in the interview, what caused the crisis? I said the immediate cause was the stimulus in 2001, 2002. But if you go back to the original cause, you could probably point to that Bretton Woods agreement where the world went off the gold standard and went on the dollar standard. Granted, the dollar was backed by gold. In fact, it was redeemable in gold. If it wasn't, then the world would not have bought into this. And of course, America we owned like 90% of the world's gold. I forget the exact amount. We were the world's biggest exporter of manufactured goods. We were the world's biggest creditor nation. So it made sense. You could see the argument for the dollar as the reserve currency. The problem is you can't trust politicians. And even though we promised to pay gold, ultimately, we reneged on that promise in 1971 when Nixon basically defaulted and we went off the gold standard. And because what happened is we basically created too many dollars during the 1960s to fund the war on poverty, the Great Society, the Vietnam War, the mission to the moon, all sorts of stuff. And we never could have funded that had we had to pay for it with gold. But we were able to print money. Now, theoretically, there was supposed to be gold backing it up, but there wasn't. And people around the world, Charles de Gaulle in France, questioned our ability to make good on these notes with gold, and there was a gold drain. And rather than reining in our excess spending and maybe devaluing the dollar somewhat, we just defaulted. And the dollar lost a tremendous amount of its purchasing power during the 1970s as a result. I mean, the dollar got clobbered against the Deutschmark, against the yen, against the Swiss franc. That's when you saw the incredible price increases of the 1970s. Oil went from $3 a barrel to $30 a barrel. All these price increases were not the result of OPEC, putting on the screws to us. It was the result of the dollar collapsing in value because we printed too many of them and abandoned the gold standard. And so prices were simply adjusting upwards to a depreciated dollar. I mean, when we were buying oil we were paying in 1970. We were paying for it in gold, but starting in 1971, we were paying for it in paper. Well, OPEC wasn't going to sell us oil at the same price for paper as when they were getting gold. So it wasn't really prices going up; it was the value of our money going down. But then, even though the dollar was revalued substantially lower, the dollar stopped falling really around 1980. It did go lower gradually, but it didn't collapse. And it had plenty of rallies between 1980 and even the present. So the dollar pretty much went into trading range where it was trending lower, but not at the trajectory of 1972 to 1978. But the world accepted the dollar during that period of time the same way it accepted it when it was backed by gold. And when that happened, that basically gave us a license to print. Because now we were able to print all this money with no gold behind it, and the world didn't care. The world started accumulating massive reserves of dollars as if they actually had value, when they have none. And the ability to export dollars, to basically write checks that nobody cashes, to buy all sorts of merchandise and all sorts of resources from the rest of the world, and not pay for it. Not pay for it with exports. We don't have to produce the goods to pay for the goods that everybody sends us. This really enabled our economy to go off on this tangent. It enabled massive growth of government, massive growth of the service sector. It enabled the basic, a collapse of our industry, of our manufacturing, and of course, that was also what's the word I'm looking for? That was also the result of government regulation and taxes and mandates that made it so costly and risky and expensive to employ people in the manufacturing sector in this country. And also you can throw in the influence of labor unions. So there are a lot of other factors that were destroying or undermining our manufacturing. But rather than having to reduce our consumption in line with our decreasing production, which might have brought about some type of regulatory or tax change to stop it from happening, we were able to replace the goods that we weren't producing by buying the goods that the Japanese were producing or that the Chinese are producing, and we were able to pay for them without producing anything, just by printing money because the dollar is the reserve currency, and they were willing to accumulate it. But the problem is the world is now, hemorrhaging dollars. They've got so many of them, and they're having to print up so much of their own money to buy them up that inflation is now a global problem. But it's all emanating from the United States. We're exporting it all around the world. We've infected the entire economy with inflation, and you have countries around the world looking for ways of dealing with it, but it's never going to work as long as they have the dollar as the reserve currency. It's not until they dump the dollar that they're going to be able to deal with their own inflation problems, because as long as they're printing money, prices are going to rise. And as long as the dollar is the reserve currency, they're going to have to keep printing money because they have to keep buying up all the dollars that we're sending them. But when they come to their senses and stop buying our currency and stop buying our bonds, they'll solve their inflation problem, but our inflation problem is going to kick into a whole new gear, because now all the money that we're printing is going to come back, and prices are going to go ballistic for Americans because we no longer have the ability to produce many of the goods that we import, and all we're going to have is paper. People think, America, the world needs America to buy their goods. No, they don't. They need us like a hole in the head. They can buy their own goods. In fact, they'd be better off if they bought their own goods, because then they'd have them. Instead, they just got our paper. What's really going to be a problem is when Americans have a bunch of money in their pocket, but you can't buy anything with it. That's a problem. Because if you can produce, then you can consume. If you can't produce, you're in trouble. And right now we're consuming without producing because we've suckered the rest of the world into giving us their production for pieces of paper. So they go without things, and they have stacks of our money, and we have all sorts of stuff. But when that comes to an end, the rest of the world is going to keep their products and consume their products and enjoy those products and those resources, and we're going to be stuck with the paper and nothing to buy. Oh, it's absolutely inevitable. The question is when. The longer they wait, the worse it's going to be. The more problems are going to be created. And there's no doubt in my mind that we will abuse this privilege until we no longer have it. We are not going to take the steps necessary to preserve the dollar's role as a reserve currency because they're too politically damaging to the incumbents. It would involve higher interest rates. It would involve letting companies fail. It would involve letting banks fail. It would be involving letting depositors and investors lose money. It would involve letting real estate prices come down. It would involve laying off a lot of government workers. It would involve cuts to Social Security, Medicare. No politician wants to do that. So we're not going to do it. And then we'll ultimately do it once we have the real crisis, after the dollar loses this status, when the currency collapses, rates skyrocket, prices skyrocket, the whole country is imploding and they're rioting in the streets, and now the politicians realize that, well, they're not going to get reelected no matter what, so only at that point might they level with the American public and do the right thing. Well, we are seeing it. I mean, people are experiencing it when they shop, when they go to the grocery store, when they go to the gas station. You see it. And the problem is also that the inflation's effect on prices, the inflation is the expansion of the money supply, the effect is that prices go up. There's a lag. It takes time for the higher prices to work their way, up the chain, up the food chain, to the end consumer. And we're seeing that. I mean, it's happening. And the prices are rising. Now, the government's measure, the CPI, is not reflecting, I don't think, the severity of the price increases that we've already seen, and I think that's by design. If you remember, the Boskin Commission in the 1990s changed the methodology for computing the CPI. And the reason they gave for doing it was that they said that all these years, the CPI had been overstating inflation. Therefore, it was giving a number that was too big, and they were going to fix it. And they were going to fix it so that the number would be smaller. Well, I'd say they broke it. It's like they broke the thermometer, and now it doesn't, you might have 104 fever, but it reads 98.6. And that's by design. And so instead of having this static basket of goods, and you simply compare that basket to see how much more expensive it is, you don't have that static basket. The basket changes. The components change. Their weightings change. The government uses hedonics. They use substitution, geometric pricing, all sorts of gimmicks to supposedly fix what was wrong with the CPI. Well, they didn't fix it. They created a situation where they can create a bunch of inflation, but then the CPI doesn't reveal it, which is what the government wants. The government wants to create inflation, but it doesn't want people to realize how bad it is. Because to fight the inflation, they're going to have to raise rates. They don't want to do that. So they'd rather pretend there's no inflation. But the public knows there's inflation. They feel it. And at some point, though, the price increases are going to be so enormous and so alarming that people are going to see through this charade, that it's going to be sheer nonsense. People will look at the CPI and they'll laugh, because prices are going to be going up at mind-boggling rates. Well, I think that GDP is not the best method for determining whether or not an economy is growing, in the sense that is it more productive? Are the residents enjoying a rising standard of living? I don't think GDP really reflects that. The problem too with GDP is you're looking at what we're spending, what the government is spending, what consumers are spending, and because the government is spending more money doesn't mean that we're wealthier. Because consumers are spending more money, especially if that money is borrowed. What if, it doesn't factor in that we have to pay it back? So if we all borrow a lot of money and spend it, that means the GDP goes up, but at the expense of the GDP going down at some point in the future, when we have to pay the money back plus interest. And I think a lot of things are counted in GDP that don't make us better off. I mean, the fact that we have a lot of lawyers, all these legal bills, increase our GDP, but are we better off because we have so many laws and so many lawsuits and all this regulatory compliance costs? We'd be better off without it. But the fact is that we are not subtracting that from the GDP. We're adding it to the GDP. The money that we spend on health care, people would rather not get sick. And so, but if you get sicker and you have to spend more money on medicine, that increases the GDP. Wouldn't we be better off if nobody was getting sick and we didn't have to spend money? What about all the money we spend on prisons? I mean, why is that? Because we're locking people up, we have more prison guards. Wouldn't it be better if people weren't committing crimes and so we didn't have to put them in jail? So a lot of things. You get a big earthquake, And the cost of cleaning up the mess adds to GDP. And then when you replace what was destroyed, that adds to the GDP. But are we really better off because we had that earthquake and we had to rebuild what we already had? So, it's really not the best measure. I think there's also a lot of double counting. I think, when a farmer grows the food, that's part of the GDP. And then when someone goes to the supermarket and buys the food, well, you're counting it again. And I think there's a lot of monkeying around with the numbers. I think the way the government uses hedonics to understate the CPI, I think it uses the same methodology to overstate the GDP. So I think there's a lot of manipulation on the part of the government to get an inflated GDP value. And of course, the minute you understate inflation, you automatically overstate the GDP growth, because the GDP growth is they always use the deflator to take out inflation to get the real number. And if you're underestimating inflation, by definition, you're going to be overestimating growth. And I think what's really important, if you want to really look at the U.S. GDP, I think you got to look at what percentage of our GDP is really wealth-producing activity versus just consumption-related, services. And if you look at the real industry, mining, manufacturing, oil and gas, agriculture, construction, stuff, really making things. If you add all those things, that is the smallest percentage of our GDP ever. It's tiny. And so a lot of our GDP is fluff. It's all spending. It's all finance. And all of that can evaporate very quickly when the dollar goes down and interest rates go up. And so when people say, oh, the U.S., our debt to GDP is not that bad, although it's pretty high, they'll point to other countries where it's worse. But if you look at our debt as a percentage of the wealth-producing components of our GDP, it is off the chart. And our GDP can contract dramatically in an economic downturn where rates are rising and consumption is shut off and the service sector implodes. The GDP collapses. The debt doesn't go away. The debt is still there. And that means now the debt is a much bigger proponent portion of the GDP. And in my scenario, interest rates also rise. And so now not only is the debt a much larger percentage of GDP, but the cost of servicing it is much higher because rates have gone up. Well, how are you going to get the money to service the debt when your GDP just imploded? And the only place you're going to get the money is from the Fed, and that's where the massive inflation comes in. Well, we don't need more regulation. We have too much regulation. We need less regulation. To say that the financial crisis happened because there wasn't enough regulation is just absurd. If that's the case, why didn't government warn us about the crisis saying we need more regulation? I mean, the fact of the matter is, I knew that it was the regulation, the abundance of regulation, that was causing the problem, because the regulation itself was distorting the free market. Did we have some minimal deregulation? Yes. Did that deregulation contribute to the problem? Only to the extent that we didn't do it enough. We removed some regulation that was there to counteract the damage being done by different regulation. And the problem is, we eliminated the counterbalancing regulation without eliminating the initial regulation that the second regulation was there to counterbalance. So to say, oh, we had the problem because we deregulated, no. We didn't deregulate enough. But meanwhile, there was massive regulation still in the financial services industry, and it's grown dramatically. I mean, I operate in that industry. And the amount of regulation that I have in my broker-dealer, and I'm not running a bank, I can only imagine that, but in my broker-dealer, it's off the charts. I mean, there is no way, given the amount of regulation in this industry, I never could have got into the business when I did. And I started my company in about 96. And, it's, what is this, 15 years later, there's no way I could do it. If the regulations that exist today existed back then, I could have done it. I would have had to work for a big firm. There's no way I could have started my own firm. I couldn't have afforded it. I couldn't have understood the regulations, let alone even afford the army of compliance people necessary to abide by them. But so to say there wasn't enough regulation, financial services, banking, brokerage is probably the most highly regulated industry in the United States. Yes, they got rid of a few regulations, but they left millions or whatever, how many they are. And to say that, well, because they got rid of a couple, it's deregulation as the cause is nonsense. If market forces were there, it was government regulation that inhibited the free market forces that would have prevented the financial crisis from happening, because you wouldn't have had all that risk taking if market discipline had been allowed to operate. But the government came in and took away all the natural free market checks. Well, Iceland had a lot of problems. I don't think it was because of a lack of regulation. I mean, there was a lot of hot money that went into Iceland, and I think that, I mean, I didn't have any money invested there, and I really wasn't that. I didn't study the situation that much because I didn't have any money invested in Iceland at all, so I wasn't involved in it. But I knew that there was a lot. They had very high interest rates, and there was a lot of hot money there, and. But I wouldn't argue that it was because if they would have had more regulation that they would have avoided the problems. I mean, look at all the regulations we had and look at the problems we have. I think that an example for Ireland is that I think that they were allowed, there was a real collapse there. They didn't get a bailout in Ireland, in Iceland. And I think, they've been dealing with the problems much more effectively than countries, let's say, that had even smaller problems like Ireland or Greece that are being bailed out by Europe. I think that they should have looked at Iceland as an example of, look, let's not interfere, and let's really have real market-based solutions to these problems instead of bailouts and artificial problems. Well, only that we're making a lot of the same mistakes that the Japanese made, trying to artificially resist market forces, trying to repair the damage done by a bubble. They had cheap money, they had malinvestments, they had a property bubble, they had a stock market bubble that burst. And rather than allowing the necessary and painful adjustments to take place, Japanese politicians repeatedly intervened and interfered. And the efforts generally focused on trying to prop up exports, mainly to the United States, so it focused on ways to suppress the value of the yen, and that was the zero interest rate policy and massive currency intervention so that Americans could keep buying Japanese products that they really couldn't afford. And this monetary policy and this stimulus prevented the Japanese economy from rebalancing and restructuring in a healthy way. And so they've dragged this process on for a long time, and now the government has taken on a tremendous amount of debt that the Japanese are going to have to repay. And this is a complete failure of this Keynesian model of government stimulus and trying to inhibit market forces, yet we're following the same model. The problem is the Japanese started in a position of strength. We're starting in a position of weakness. They had tremendous domestic savings. We don't. We have huge external liabilities. The Japanese had and still do have substantial trade surpluses. We have huge trade deficits. Japan is, I think now it's the second largest creditor nation to China. We are the world's largest debtor nation. So, I think that we're going to suffer more deeply from following the Japanese policies than Japan. Japan was borrowing money from itself. We're borrowing money from Japan. We're borrowing money from China. We're borrowing it from the rest of the world. And we're borrowing it to consume. The Japanese still have trade surpluses. Right? We are squandering this money on consumption. And so we're not making the necessary investments to grow our productivity, to make our economy more productive and more efficient. Other economies are becoming more productive and more efficient. All we're doing is spending money. Well, I think the big issue we're facing is, is this country going to survive as a republic, or now a democratic republic with some semblance of the free market? We've certainly distorted the vision of our founders dramatically, but still, we're not a completely centrally planned economy. There are still a lot of elements of capitalism operating beneath the surface, even though government certainly makes it a lot less efficient than it would otherwise be. But to the extent to which we have infused capitalism with socialism, and we've had a lot of problems, the purveyors of that socialism have been able to successfully blame capitalism for the problems that they created by interfering with it. And in the financial crisis of 2008, politicians were very successful at blaming capitalism, using Wall Street as the poster boy, even though there was very little capitalism on Wall Street. In fact, that's probably where there's the least amount, because you have all this cooperation with the federal government and the Federal Reserve, and there's very little capitalism. It's statism and corporatism, and central planning. But the politicians were able to vilify capitalism and justify big government programs to rein in the damage and rein in the excesses. And so the government got bigger, the Federal Reserve got more power. Instead of surrendering the power it had, which would have been a good thing, it got additional power to do now more damage. And the concern for me is when this greater crisis hits, will we finally completely write the obituary for capitalism in America? I mean, because it's going to be really, really bad. And will we say, look, we just got to scrap it completely, and we need a totally centrally planned economy, run by Barack Obama or somebody like him who makes all the decisions, and Congress decides, who works where, what gets produced, who consumes, who does what job. I mean, are we going to embark on that model because of how bad things get, or will we finally correctly understand that it is government interference that is responsible, and will we re-embrace the free market, laissez-faire, capitalism, sound money that was given to us by our founders, and that was responsible for America becoming the wealthiest country in the world in the first place? We became very successful following that blueprint. Will we go back in that direction? That is what I hope, but my fear is that we move in the other direction, which would be a disaster, because then if we do that, in order to get back to real capitalism, it may require a violent revolution at some point in the distant future. So I certainly hope we don't go in that direction, but we are certainly going to approach that fork in that road. It's unfortunate. But things are going to get really, really bad in this country. And, I'm out there, I do my radio show, I'm writing books, I'm trying to inform as many people as possible so that they know who's to blame. The crazy thing is all the people who said everything was great in 2007, 2006, the economy had never been better, everything was fantastic, they couldn't see this train wreck coming, even though it was staring them in the face. They're the people who are still in charge. They're the ones who are fixing the economy when they don't understand why it broke. In fact, they broke it, and they're trying to fix it by doing more of what broke it in the first place. So it really is amazing to me, and hopefully this time they'll be completely discredited instead of given even more power to do the ultimate damage. Well, I mean, I don't know all the mechanics of it, but I mean, you just do it. I mean, they're basically, obviously the price of gold is going to have to be readjusted given what the monetary base is now, but we have gold. I mean, at least I hope we have gold in Fort Knox. So the government could set some kind of ratio legally between the amount of money in circulation and the gold that we have in Fort Knox. And that would obviously require a major devaluation of the dollar, because right now officially the dollar, gold is $42 an ounce. I mean, it doesn't even reflect the market today, because gold's around $1,500, let alone what it would have to be to go back to a gold standard. But we can do it. And then once we did that, then the money supply would no longer be able to grow. It can only grow to the extent that we've got more gold. And, we could get more gold. How would the government get more gold? Well, they'd have to get it. They have to raise taxes, and they'd have to take gold from the people who are earning it. Because we'd get more gold mining, and people would take the gold and bring it to the government would be able to take that gold in, buy it with tax money, and then it could issue new bills based on the fact that it acquired more gold from the mines that were producing it, and so the supply of gold could grow, and maybe it would grow by 2% a year or something like that. So the money supply would grow by roughly the same amount. But then all of a sudden the government would have to live within its means. The deficits would stop, because if the government doesn't raise taxes, it doesn't have gold to spend, so it can't spend, and it would force fiscal responsibility on Washington. It would once again, savers would know that they have real value. It would encourage savings. It would, it would do wonders for the economy. It would empower the free market, and it would disempower a government, and that's what we want. But are we gonna get there? I think eventually we will, because I think there is no alternative, because fiat money doesn't work, and so eventually we're going to have to go back to what works. But the longer it takes us to acknowledge that, the more pain we're going to have to endure as a society. Well, I mean, deflation. Look, deflation is is the cure for what ails us. It's not negative. I mean, first of all, only in government Orwellian world, twilight zone of economics, is it a bad thing when things become more affordable and less expensive? Would it be a terrible thing if college tuitions went down instead of up? Would it be a terrible thing if when you got your health insurance premium, it was lower than it was the year before? No, everybody would be happy about that. Everybody likes a sale. People want to go to stores when they're reducing their prices. Stores don't advertise, hey, we're charging an extra 10% today. Rush on in and buy. Lower prices are a good thing. And we experience that with cell phones. We experience it with computers, with television sets. They're getting better and they're getting cheaper every year. Yet the industries are thriving. So are falling prices hurting the cell phone industry? Are they hurting consumer electronics? No. In fact, they're helping, because by prices coming down, they get more customers. A lot more people can afford plasma TVs when they're under $1,000 than they were $10,000. The reason that so many people have cell phones today, I remember the first cell phone that came out, back in the late 80s, it was thousands of dollars. And just to use it, it cost a fortune to make a call. So only really rich people, you had it with your private plane and your chauffeur-driven limousine. You had a car, a car phone. But now, look, there are people that are collecting welfare that have cell phones, right? They have a lot more customers now because the prices came down. Prices coming down are a good thing. Prices fell in America from 1800 to 1900. For 100 years, prices were declining. If people talk to their grandparents now, or their great-grandparents, and they'll tell you stories about, hey, I remember when penny candy was a penny, and I went to the movies for a dime, and I can't believe how expensive things are. Well, in 1900, when kids were talking to their grandparents, it was the opposite. Their grandparents said, you know how expensive that was when I was a kid? Oh, it's half the price now. You're lucky. So we didn't always have inflation. Inflation is a gift or a curse of paper money, of the Federal Reserve. We went through the Industrial Revolution, right? The most prosperous period of American history, the Industrial Revolution, between the period of the Civil War and the First World War, where we grew our standard of living at a faster pace than ever. We migrated people from the farms to the cities. We absorbed immigrants from all around the world. All the inventions of industrialization, the assembly line, everything that we did. I mean, all the consumer goods that were created, automobiles, airplanes, telephones, indoor plumbing, washing machines, dishwashers, vacuums, typewriters. I mean, all this stuff that was invented during the Industrial Revolution. And we had this huge increase in our standard of living. We had deflation. Prices were falling. It didn't inhibit that. In fact, it was a benefit. It was the reward, right? Prices went down so you can afford more things. Your standard of living rose. The enemies of deflation, the government doesn't want deflation, because if deflation hurts debtors. Well, the government's the world's biggest debtor. They can't afford deflation. How are they going to pay back the national debt if money gains value? So the government wants deflation. Of course, if prices deflate and wages deflate, that means the government loses tax revenues. People fall into lower tax brackets. You see, ultimately, if your cost of living goes down by 50% and your wages go down by 40%, you're better off. You're better off making less money if prices go down, right? So that would be good deflation. You make less money, but the prices go down even more, and so you have more purchasing power. But the government hates that, because now if you make less money, you're in a lower tax bracket, right? And so the government can't stand. The government wants people. They want inflation. They want people going into higher tax brackets. So government fights deflation because deflation is bad for government, but it's good for the private sector. You know, you know, so the government creates, I think, this artificial boogeyman of deflation, so it can do what it really wants to do, is create inflation. And then it can tell us that inflation is a good thing because we've been saved from the pestilence of deflation. And you hear that all around. Hey, we dodged a bullet. You know, the Fed is fighting deflation. Why do they have to fight that? They're fighting my cost of living going down. They're fighting my ability to buy gasoline cheaper, to buy food cheaper. You know, I don't need protection from cheap food and cheap gasoline and cheap health care and cheap... I want those things, you know. But what I don't want is for my cost to go up. And that's what happens when the government creates inflation. Yeah, I think Tom has used that analogy too. Basically, it's a very simple explanation of the business cycle and the mistakes that are made because of the false signals sent to the market by the government. And I gave the example of, let's say a circus comes to town, and it's a small town, and so there's obviously a lot of people in the circus. And all of a sudden, all the people that work at the circus start eating in a local restaurant. Now, the owner of that restaurant, he sees all this new demand. He's got a lot of customers he didn't have before. And he misinterprets that. He thinks, well, gee, you know, this is great. I need to expand. And maybe he rents additional space and expands. Maybe he rents the space next door and builds a bigger restaurant. He hires additional waitresses to take, because he's got a lot more customers now. And for a while, everything is great because the people in the circus are coming to the restaurant. Well, then all of a sudden, you know, it's time to move on. They pull up their stakes and they all take off. And now the demand is right back to where it was. The circus is gone. But now the business is expanded. He's got too much capacity. He's got extra space he doesn't need. He's got waitresses and busboys he doesn't need. He's got dishwashers. What is he going to do? He made a mistake. He misinterpreted that increase in demand as being a permanent increase, and he made changes based on that misinterpretation of what was happening. Now what does he have to do? Well, now he's got to, you know, he's got rent, he's got to sublease some of his property, he's got to lay off some of his workers. Yes, this is bad news for the people who are losing their jobs. Maybe it's bad news for the landlord who's not getting his rent, but it's necessary because now he's got to correct the problems. He's got too many people standing around doing nothing because there's nobody eating in the restaurant. They need to do something productive. They need to apply their labor in a more efficient manner. It was allocated improperly based on this entrepreneur's bad decisions based on this signals that he got. And that's the good thing. Now the government would say, oh no, we can't allow this recession. We need to keep those waitresses in place. You can't lay these people off. We need to give you stimulus money so that you can keep a bigger staff than you actually need, so that you can keep using space that you don't need, space that maybe, you know, a hardware store would go in that we do need, but now we have a bigger restaurant than we can actually support. And maybe the people who are being taxed so that they can stay working at the restaurant, well, what are they not doing? You know, what's not happening because they're where they shouldn't be. You need to allow that process. And so that happens. I said, you know, the Federal Reserve, you know, it's like the circus coming to town. There's all this phony demand. They print all this money and people go and spend it. And a lot of it came from home equity extractions and the wealth effect. And then you have all these shopping centers that develop to service all this demand, and all these finance companies to finance all this consumer credit. And, you know, but all of a sudden, you know, it's gone, and then you've got this whole infrastructure that's been built up that was phony. Because Americans, we're spending beyond our means. There isn't this demand. We really can't spend all this money because we don't produce. We're consuming all these goods that we don't produce. So it is not legitimate demand. It is phony demand. It is emanating from the monetary policy of the Federal Reserve. And the economy has now very malinvested. We've made all sorts of bad decisions and mistakes on what businesses to fund, where our capital is, where our labor is. And when the circus leaves town, it's going to be a complete disaster. And the fact that the government is trying to continue these malinvestments and these bad allocations, all that does is delay the cure. It delays our putting our resources, our land, labor, and capital back in a sustainable, efficient manner. But the adjustment process is that painful process that the politicians want to prevent, because they want to get reelected, and they don't get reelected by leveling with the public about how bad things are going to have to get in the short run. They get reelected by promising a quick solution, and the only quick solutions are the ones that make the problems worse.